hot buttons for global banks as they build resilience for a very different future includes risk management revamp, people, artificial intelligence, technology partnership, and rediscovering customer intimacy. Central banks must also find their way through the macroeconomic fog with rising pressure on regulatory institutions and importance of the effectiveness of central bank monetary policy processes and interventions. As we enter the final quarter of 2025, I had the privilege and opportunity to lead a discussion with Nigeria Central Bank officials last week, and we spoke on global macroeconomics and the banking industry. I will cover some of the issues discussed in this episode. Hello, this is Global Business Insight, where we look in more depth at some of the current business issues. Like I said this week in a previous episode, America's biggest financial firms kicked off the third quarter earnings season with strong performance. We saw JP Morgan Chase, Wells Fargo, Citigroup, and Goldman Sachs reporting significantly higher quarterly profits, while BlackRock, the world's largest asset manager, announced a record $13 trillion in assets under management. Banks benefit from a rebound in mergers and acquisitions, revenue from volatile trading, and all-time highs in the stock market. But analysts warn of rising bad debt exposure to low-income consumers and lower-rated corporate borrowers. There is also concern that some parts of the equities markets have bubbled up and are vulnerable to correction that could have a broader contagion effect on the economy. But chip-making giant Taiwan Semiconductor Manufacturing only this week announced a record quarterly net profit and raised its revenue guidance on the back of artificial intelligence strength. The world's largest chip manufacturer somewhat allayed concerns that investment in the technology is inflating a bubble, as many economists continue to warn. In the United States, analysts are also trying to unravel how growth continues to look healthy amid weakening labor markets, possibly attributable to uncertainty holding back hiring and firing and the artificial intelligence impact on productivity, with organizations being forced to find savings to finance an expensive new technology-driven trajectory. Some argue that the case in the US court on tariffs could materially affect the context, while others say the decision will not be material to countries which are already actively reshaping their alliances to be more resilient in a less predictable trade environment. The uncertainty remains palpable. Europe's economy is unprepared for another major continental escalation with an extensive downside contagion. As higher tariffs slowly bite, I suspect a cautious Powell may be proven right as US economic growth slows despite lowering of interest rates. The dot plot of individual FOMC members' expectations, that's in the US, showed the group split 10-9, with the slim majority expecting 2 more cuts before the end of the year. And in Europe, top European Central Bank board members say the easing cycle is done or almost done. Also, development aid is shrinking and the appetite for trade-related concessions also diminishing as advanced economies like the UK struggle to balance their budgets, with many battling fiscal pressures and aging populations expanding welfare burdens. Looking at banks, to cope with a tough environment with sticky inflation and escalating costs, they will have no choice but to go after waste, go after inefficiency, with more headcount reductions looming, helped by value realization from adoption of the new expensive technologies such as generative AI. Tomorrow's banks are using generative AI in human-in-a-loop mode or co-pilot mode to reshape their business models and achieve more personalized, customer-centric innovation. Call memos will now be scripted in seconds. Credits are analyzed against criteria in minutes, and decisions taken in a few hours instead of days or weeks. Productivity could rise 30 to 40% as revenues from new business also goes up 6%. But there are many other new risks. Artificial intelligence comes with so-called hallucinations and errors. If the co-pilot relationship is not well managed with skilled bankers, wrong decisions could easily be taken. Also, the largest bank in 2030 may actually be non-banks who already hold 60% of private sector financial assets, as we see a rise in shadow banking, which presents new challenges as customers cannot distinguish the difference between, say, a Max and Spencer bank and Santander, or between Amazon and another bank. Another source of risk could be cyber-related risks. Banks invest more in cyber defense, but there are more new risks. After years of near zero interest rate in the West, higher rates could impact risk of default, exacerbated in, for example, a commercial real estate sector with hybrid work and less demand for office space. So we could see shifts in the business model also impacting this higher risk of default. High technology sectors also imply new technical and technological complexities. Banks looking at balance sheets of many of these tech-driven organizations will be exposed to new risk of technical obsolescence in a completely new artificial intelligence era, which, by the way, is still in very early stages, which happens also to be the riskiest stage as far as obsolescence is concerned, with a very limited and narrow knowledge by banks of the potential developments in the technology. Banks, of course, will now need analysts who understand AI technology to be able to appraise the more complex developments. The rise in cryptocurrency, helped by US institutional acceptance, and some of the collapses we have seen related to lack of transparency with crypto transactions and ease of fraud, are all new risks for the sector. We have also seen of late a sharp rising count in unregulated crypto transactions as Africans hedge against inflation and use of crypto like Bitcoin to bypass capital flow controls. Another trend in banking is the increasing advantage of scale, as the winners are able to use scale to leverage unmatched efficiencies, and finding economies that others cannot is going to be a major part of resilience. But more importantly, the winning banks will find ways of leveraging talent and Gen AI to rediscover customer intimacy, which was somewhat lost when rapid digitalization turned banks more into machines. And the question that is increasingly being resolved today is, how can artificial intelligence be a strong partner for humans to get more customer-centric services? So what does this all mean for central banks? Pierre-Olivier Gorichas, chief economist of the IMF, warned this week that pressure is ramping up on central bank institutions. Indeed, the monetary policy setting role has become more sensitive and important than before because of the vagaries and less predictability associated with inflation. The transmission of policy decisions in impacting domestic macroeconomics is also becoming much more complex. Central banks are going to need to be more independent as geoeconomic and political pressures ramp up in resolving the trade-offs associated with interest rates and economic growth. Data dependence is increasingly critical because of the multiplicity of factors at work, but can be tricky, especially if data is sparse, as we see in some jurisdictions, or even worse, unreliable, with very significant revisions made after decisions. Policy signaling, forecasting, and monetary policy committee member dot plot surveys remain best practices to help stakeholders digest policy interventions more proactively. Communication will be even more important than before, almost as important as policy development itself. Regulators are also now perceived to be pushing more borrowers to the non-bank sector as we see fewer new banks due to tougher rules, and a more proactive courtship of the fintech sector seems to be evident. There is already a perception of too many bank regulations not linked to factors driving bank failures, and a growing call for a shift in the conversation with a needed recalibration. Regulators and banks will be working together to get the right balance and better focus on causes of failures. Issues like liquidity risk, market risk, capital risk, and rising fraud risk will all be revisited. And it is still unclear if we will see a trend to see fewer, simpler regulations as the United States under Trump moves faster next year in this direction under a new Federal Reserve governor. That is after Jerome Powell. U.S. Treasury Secretary Scott Bessent already says Fed reform should be expected, and other central banks may emulate the U.S. Central banks are doing more artificial intelligence-driven scenario planning, where different macroeconomic possibilities are studied to see how policy should respond to the dynamic drivers. Increased digitalization of compliance reporting is another trend to reduce costs and maximize efficiency of supervision. To summarize, the macro environment presents more complex and less obvious technology obsolescence risk, loan default risk, as a different artificial intelligence hits the less resilient business models, crypto-related fraud risks, and also cybersecurity risks. Risks are elevated at a time when new opportunities are opening up, especially in emerging markets, as more capital flows into better yields. Already, Nigeria is getting ready with higher capitalization requirements to position for the $1 trillion economy, and the banks will play a key role with more specialized niches like energy, infrastructure, agriculture, technology, and mortgage banks, for example, targeting specific development sectors. In Africa, the broader macroeconomic pressures may also be reinforcing the need to go back to basics of prudence, independence, data dependence, and caution as apex banks approach their important roles in supporting a renaissance still at early stages in the continent, and also as the policy mix vastly improves in developing economies. Two more stories, but still on the theme of banking. Just yesterday, German Chancellor Friedrich Merz called for establishment of a single European stock exchange, signaling support for plans to unify European capital markets. This, he said, was to avoid a situation where successful firms from Germany go to the New York Stock Exchange to list. And in Nigeria, Zenith Bank PLC concluded its public offer and attaining the Central Bank of Nigeria's recapitalization target. The bank's public offer, which was oversubscribed, raised 350.46 billion naira, bringing its total capital base to 614.65 billion naira, comfortably above the 500 billion naira regulatory threshold. We also saw yesterday the S&P 500 down almost 1% as two regional lenders, Zions Bancorp and Western Alliance Bancorp, disclosed issues with loans involving allegations of fraud, raising concerns related to borrowers' credit worthiness. In Asian markets, South Korea's Kospi hit a record high for the third straight day before giving up gains as trade talks progressed with the US. Well, that's all we can take on this very special episode of Global Business Insights. This is Monday. Thanks for watching. Enjoy your weekend. Bye-bye.